Let's talk to Marc Ostwald. He's a strategist at ADMISI. Very good morning to you, Marc.
Good morning.
This is my favourite slot of the week. I shouldn't tell anyone that, but there you go. Right, you've sent 3 thought-provoking slides. Let's kick off with the first one. US 10-year yield ticking up. I remember at the beginning of the year you said 3% is the level to watch.
Yep.
Doesn't look too far off, does it?
Well, we're gradually marching upwards. Not that you would actually notice it when one looks at either the performance of the dollar, which has obviously been very weak.
Yep.
These much better than expected yields are not attracting money into the dollar. We can probably blame debt ceiling problems, which are obviously coming to a head as being part of it. But also some hope that not only is the Fed walking away from low interest rates, but so are the ECB and BOJ, but they're a long way behind. So where one really has to keep an eye on here is if we keep on marching this higher, the first instance is, well, this doesn't seem to be much of a problem for corporate issuance, which is coming by the ton. We're well over 100 billion for the month in investment grade, and we're well over 10 to 15 billion for high yield, and that's just US dollar. And equity markets looking over across at the bond markets and saying, well, should we be worried about that? Well, there seems to be an element of complacency, and I would call it almost sort of Pavlovian complacency in the sense that we've had other occasions, beginning of last year, for instance, where we've marched yields higher and people have gone, well, do we need to start worrying about other riskier credit asset markets, or should we, as ever, buy the dip in response to any rise in yields? Well, at some point, that chain or that chain reaction breaks. And I think that the worry here is that we're actually getting to the stage where people are not paying enough attention to this rise in yields. If we move on to the next chart, this is the US-German 10-year yield spread.
The differential, right?
It certainly tells us that since November, the rise that we've seen in US yields has been dragging others higher, along with the fact, obviously, that the ECB's cut its QE program as of the start of this year, and we're now starting to speculate, will it end in September? That seems to be the general consensus. However, that's all well and good, but the real big question there, and the one which may drive the spread towards last year's high at 220, and that will definitely have a knock-on effect onto euro-dollar, which is quite sensitive to this, is when is the ECB going to hike rates in the first instance? And this is where we seem to have the return of the doves on the ECB coming in. We had Mr. Constancio yesterday, the Vice President of the ECB, basically saying, I'm not really liking this rise in the euro. That was followed up by Mr. Novotny, who's head of the Austrian Central Bank, also talking about that. That in itself points to the idea that this promise that the ECB have made, that they will keep rates low long after they've ended their QE program, even more likely, they have reintroduced this as an element. For about a year, the ECB has basically made almost no mention of the euro. But now, with this fairly rapid rise, one has to admit, it seems to be more of a problem. That in turn means that the ECB may not hike rates until, say, Q1 of next year, by which time, even if we have the more dovish view on Fed rates, which is basically 2 hikes this year, maybe 2 more next year, the premium that's on offer, particularly in short-dated interest rates in the US, starts to look inordinately attractive and rather irresistible. Be that as it may, the other thing which we need to look at, and on the next chart, is inflation rates. Obviously, the ECB, I think, to a certain extent, to relate back to the previous comment, has been less worried about the improvement in the euro because of the rise in oil prices. And this rise in the 10-year break-even inflation rate certainly is all about oil prices. It's rather less responsive, one would say, to broader CPI, but one can see way back here at the beginning of 2016 that was the bottom for oil prices, and we were factoring a very, very low inflation rate. But we've steadily risen We're not as high as we were when one thinks at the beginning of last year we had much more inflation fantasy, if one wants to call it. And that's, of course, this time last year we were talking about $45 to $50 for a barrel of oil, not 63, 68.
Yeah.
So that will probably impinge. Also, the other thing to note on this is actually we may be underestimating how fast US inflation rises. Obviously, this isn't going to be a proxy for how fast the actual nominal data rises, but we may need to be factoring in a rather higher level, both because of higher oil prices and also because there are some big base effects. One of the reasons we took that break-even inflation rate down last year was because suddenly between February and June, we saw prices falling and the Fed started worrying about it sort of more openly, even though they've explained it away largely as due to one-off factors which will gradually work out the way. But perhaps the break-even inflation rate needs to be closer to 2.5. And if we're at 2.5, then the 10-year yields, which we were looking at earlier, at 2.6, look wholly inadequate for an economy which is growing pretty well.
Okay, so the headline on here is you think that inflation is going to go higher than the markets are anticipating.
Yes, and as I've stressed before, this is not talking about an inflationary period. It's just that what markets are discounting in the way of inflation is too low. It's not that there's something really to panic about. Oh my goodness, we're going to have our wages eroded by inflation and the Fed really needs to get on. It's to say, instead of discounting the 1.8 to 2, we may need to discount 2.3 to 2.5. And that has a massive impact on real yields and on investor returns as a result.
Mark, brilliant stuff. Thank you very much indeed.